Good evening to all of you joining us from the US, and a very good morning to everyone attending from India. I am Vasamati, Marketing Head NRI Wealth Plus. It's a pleasure hosting you all for this special webinar on inheritance planning for NRIs. This is in continuation of a series of webinars planned specifically for our NRI customers. We are delighted to have such an engaged audience across time zones. Many of you may already be familiar with integrated, but for those who are new investors or joining us for the first time, allow us to briefly introduce who we are. Let's begin with a short 2-minute video that captures the essence of integrated and our journey.
1974. Indian financial markets were in a nascent stage. Highly underpenetrated, ignored, misunderstood. The middle class was missing out on their potential for wealth creation, till one man made it his mission to change the status quo by pioneering a business model for retail investors. Shri P. Vaidyanathan, a qualified chartered and cost accountant and a company secretary with an established family audit practice. He left it all to start Integrated Enterprises on the 14th of April 1974 from the temple town of Kumbakonam, Tamil Nadu. Integrated Enterprises, more than a company, a long-term wealth partner. 1,200 committed employees serve 1 million customers. Backed by a robust tech platform and physical presence. This is our signature phygital omni-channel mode. We reach global Indian investors as well, offering personalized investment solutions. Why do 3 generations of customers stay with Integrated? Because we never sell anything. We empower our customers to make informed decisions. And our business is run with transparency and ethics.
With our own unique investment framework of growth, income and protection, this investment philosophy will help our customers secure their financial future. With over 50 years of trust and track record and dedicated leadership managers, we want to be the preferred long-term wealth partner for our customers.
Thank you. As you saw, Integrated has been a trusted partner in wealth creation and management for over 5 decades. Under our NRI Wealth Plus initiative, we not only offer investment services but also provide non-financial support, including geriatric care tie-ups for aging parents in India, health insurance solutions with a co-pay concept tailored for senior citizens, inheritance planning assistance, tax filing support for NRIs and their parents in India. To strengthen our tax and compliance offerings, we have partnered with Manohar Chaudhary and Associates, a reputed firm established in 1984 with over 14 branches across India. They are well known for their specialized services for NRIs based in the US, UK, UAE, Australia, to name a few. We are privileged to have with us today 2 distinguished speakers from the firm, Mr. Amit Patel and Ms. Mitsu Dalal. Mr. Amit Patel is an All India rank holder, chartered accountant, a graduate of Narsi Monji College of Commerce and Economics, and a widely respected thought leader in taxation. He served as an independent director for major financial institutions such as LIC Housing Finance, SBM Bank India Limited. He has been associated with CII, BCAS, ACAI, and Income Tax Department's training institutes. His insights have been featured in platforms like Money Control, NDTV, ET Now, CNBC, and he has authored several papers and books on taxation. Joining him is Ms. Mitsudalal, a chartered accountant with over 14 years of experience in both direct and indirect taxes. A graduate from Nancy Munji as well, she brings deep expertise in NRI taxation, tax advisory for FPIs, and representation before Indian tax authorities. We are honored to have both of them take us through today's session on gift and inheritance planning for NRIs. Please join me in warmly welcoming Mr. Amit Patel and Ms. Mitsu Dalal. Over to you, sir.
Thank you. Is the screen visible, Vasumati? Okay.
Yes, sir.
Okay. Good day to all the clients of Integrated Enterprises. Me and my partner Mitsu, as well as my third partner Sachin. We are delighted to be partnering with Integrated to provide information and share our experience about the Indian taxes with all of you. It's very heartening to note that so many of you have logged in on a Friday evening to learn something about Indian income taxes. And let me assure you that over the next maybe 45 to 60 minutes, we will take you through some of the important aspects of taxation as far as NRIs are concerned, particularly with reference to inheritance and gifts, because over the period of last maybe 25 years, we have had multiple webinars for our other clients. And across these webinars, there have been several questions that have come to us on this topic. And therefore, we felt it appropriate that we begin our innings with integrated enterprises with this subject. And we hope that there will be many more such webinars to come in future, and that we will get an opportunity to interact with all of you across the world on a more frequent basis. So once again, thank you so much on behalf of everyone at Manohar Chaudhary and Associates, or Team MCA as we call ourselves. Some ground rules. All of you are from USA, or maybe most of you are from USA. And even if you are from any other country, please understand that what we are going to talk about today is basically taxation impact on inheritance and gifts for various assets in India for non-resident Indians. So our focus today is on taxation. Our focus today is for NRIs or non-residents, and we would not be really focusing on two other aspects which are also relevant for you, but which would require another 2-3 hour session each. And therefore, we will not touch upon those in detail today, which is the tax angle in USA itself or in your country of residence, because that also is extremely important, because any income which you earn in India could have a tax impact in your country of residence. So we will not be touching upon that. However, we are happy to answer any queries that come up during the course of this webinar or even later via email. As we have, as mentioned earlier in the introduction, we have sufficient experience of dealing with taxation in other countries, particularly USA, because we have our own establishment in USA itself. So that is the second thing. And third is we would also not be touching in detail on the Foreign Exchange Management Act, the FEMA angle to various transactions in India. Last ground rule is that please don't waste your time in taking screenshots of photographs or notes of this various slides. We are happy to share the entire presentation with all of you. Our email IDs are there in the last slide, which we'll come to at the end of the presentation. But we are happy to share this. And even later, if anybody has any queries, you could write to us via Integrated, and we would be happy to assist you. So let's start the presentation. Some of the slides, initial slides, I will be taking up, and later Mitsu will take over. In the meantime, if any queries do come up in the chat box, Mitsu or Sachin will try and respond to them, live. First things first about gifts. So while the subject or the topic circulated was about inheritance, but because of our experience of dealing with non-residents, we realize that gifts are also equally important when it comes to taxation in India. Therefore, we'll begin with gifts. In principle, the taxation is similar for gifts as well as inheritances. So first of all, gifts can be received in various forms. You could receive it in the form of money, or you could receive a movable property by way of gift, or an immovable property by way of gift. Gifts are generally received without consideration, but there could be some circumstances where you get some asset, you pay something to the person who's giving it to you, but that is not the entire value of the asset. So, for example, somebody gives you a motor car, for example, which is worth 25 lakhs, but you pay only 5 lakhs. So that is considered as inadequate consideration or inadequate price. And that could also result in a gift. So gifts could be in the form of movable property and immovable property. Movable property could be shares, jewelry, archaeological collections, drawings or paintings, sculptures, etc. Immovable property can be land or building, and the building could be commercial as well as residential. The most important thing that you must keep in mind, and you could probably get some wrong information on the internet. A lot of people have this, cultivated this habit of looking on Google for solutions. So you may get a wrong information or wrong solution on the internet. Please understand that in India, there is no gift tax. Long back, we had a statute called the Gift Tax Act, but that was abolished long back. And therefore, technically, there is no gift tax in India today. However, gifts in excess of 50,000 rupees are taxable in the hands of the recipient under the head income from other sources in some cases, and we'll come to which cases they are taxable. But otherwise, as far as the donor is concerned, as far as the person who's giving the gift is concerned, there is no tax liability or no tax implication in India. Please remember that we are talking about gifts received in India. If you receive, because all of you are outside India, if you receive gifts outside India, that is not within the scope of taxable income in India for a non-resident. What is not considered as a taxable gift in India? So, gifts received from relatives. There are various types of gifts which are not taxable in India. The most important being gifts received from relatives. And this exemption will apply irrespective of the amount involved. So whether you receive, 100 rupees or $100 in India from a relative, or you received 100 crores, it doesn't matter. Independent of the amount involved, gift from a relative is not subject to tax in India. However, the onus of proving that you have received the gift from a relative would be on you. Obviously, if you have received a gift and you claim that a relative has given you the gift, the onus is on you to prove that. And naturally, when you're talking of the term relative, it obviously means that you are talking about individual. So an individual receiving a gift from a relative in India would not be subject to tax in India as far as the gifted amount is concerned. But HUFs have also been sort of given a concession as far as gifts are concerned. So when HUF receives a gift from a member of the HUF, it is considered as having been received from a relative. But more importantly, from an individual perspective, all of us in this webinar today are individuals. So who is a relative in the context of each one of us? If I receive a gift, then what is important for me to find out is whether the other person, the person who has given me the gift, is my relative or not, as defined in the Income Tax Act. So in this context, the definition of relative is that a spouse, the spouse of the individual, brother or sister of the individual, brother or sister of the spouse of the individual, brother or sister of either of the parents of the individual, any lineal ascendant or descendant of the individual, any lineal ascendant or descendant of the spouse of the individual, and lastly, spouse of the person referred to in B to F. So Just to illustrate or to explain this better, if I get a gift from my spouse, from my wife, it is not taxable in my hand. If I get a gift from a brother or sister, it is not taxable because brother or sister is considered as a relative. If I get a gift from my wife's brother or sister, and in this case, it is not cousin brother or cousin sister, it is blood relative, then again, that is not treated as income in my hand. Brother or sister of either of my parents. So first, let's go to the next one. Any lineal ascendant or descendant. Obviously, this should mean, father, mother, grandfather, grandmother, son, uh, daughter, or grandson, granddaughter, and brother or sister of either of my parents. So if I receive a gift from my father's brother or father's sister, or my mother's brother or mother's sister, then that also is considered as gift from a relative. And similarly, if my brother's wife or my sister's husband gives me a gift, that is also considered as a gift from a relative. So if you receive a gift in India from any of these kind of people, then for you that person is considered as a relative, and therefore any amount that you receive, any kind of gift that you receive from that person, will be treated as having been received from a relative and would therefore not be subject to tax in India, in your hands. The other type of gifts which are not taxable in India are gifts, or money received on the occasion of marriage of the individual. So when you receive, if you are getting married in India, and on the occasion of your marriage, you receive gifts in cash from from anyone for that matter, and here the bar or the condition that it has to be from a relative is not applicable. Next is money received under a will or by way of inheritance. So this is linked to the main topic that we will be considering today or discussing today about inheritance. So when you receive something by way of inheritance, it is not treated as a taxable gift in your hands, and therefore there is no tax implication in your hands. As I mentioned earlier, for the donor, in any case, there is no tax implication in India when that person gives a gift, and similarly when that person bequeaths certain assets to you by way of inheritance. And last important exclusion from taxation is money received from any fund, foundation, university, or other educational institution, hospital or medical or any trust or institute. Means if there is a charitable trust from which gives you money to help you in times of financial stress, if at all, then that is also not considered as a gift or a taxable gift in your hands. The interesting point over here, as we saw earlier in the definition of relatives, a brother or sister of either of the parents of the individual is considered as a relative. So if I am talking about my uncle or my aunt, if I get a gift from them, they fall in the definition of relative. But if you look at this definition closely, the son or daughter of either of my uncle or auntie are not considered in this definition, and therefore, while uncle or an aunt is a relative for the nephew or the niece, as far as the uncle and aunt are concerned, the nephew or niece are not treated as relatives in the definition of relative, and therefore, if you receive a gift from your nephew, even your blood relative or your blood brother or blood sister's son or daughter, that person who is giving you the gift is not considered as a relative, and therefore the exclusion, the exemption from tax for gifts in excess of 50,000 will not apply to that. And if you receive more than 50,000 from your nephew or niece, it will be treated as taxable income in your hands. The other important point that please keep in mind is that while your spouse is considered as an individual, therefore, if you receive a gift from your spouse, at that point of time, there is no taxation. However, income earned by the spouse from the gift given to that person by the other spouse will get clubbed in the hands of the person who is given the gift. So to illustrate, if I give a gift to my wife, in the hands of the wife, that amount is not treated as income. But when my wife invests that money somewhere and earns income on that amount, that income will get clubbed in my hands. So one has to be careful about these things. There are nuances which apply and which may not clearly come out if you do a Google search. Now let's come to when these are how the taxation works. If you receive money, the entire amount in if the gift is more than 50,000, then the entire amount. So 50,000 is not a threshold. 50,000 is just a qualifying amount. The moment you cross 55,000, the entire amount would be treated as a gift if it is from a person other than a relative. In case of movable property, if you receive it without consideration, then the aggregate fair market value of the property would be taxed in your hand if that aggregate fair market value is more than 50,000. So in that earlier example that I gave, someone gives you a gift of a car and the value of the car is say 500,000 rupees. Obviously it is more than 50,000. Then the entire 5 lakh rupees, the aggregate fair market value of that car would be treated as income in your hands. On the other hand, if it is not without consideration, but for some consideration, but the consideration is inadequate. In the same example, a 500,000 rupees worth of car is gifted to you. You pay 100,000 to the person who has given you the gift. It is treated as having been given to you for inadequate consideration. So 500,000 minus 100,000, that is 4 lakh rupees, would be treated as the value of the gift in your hands. What is the meaning of fair market value? Fair market value is defined over here. I mean, I don't need to get into the details. As far as the immovable property is concerned, it is interesting because if it is received without consideration, then the stamp duty value of the property will be taxed in your hand if it is more than 50,000. Obviously, immovable properties will not be less than 50,000. So that entire amount of stamp duty value would be taxed as income from other sources in your hands. And if it is for inadequate consideration, the difference between the stamp duty value of each immovable property and the consideration paid, if the difference is higher of 50,000 and 10% of the consideration. I'll explain what this means. It's a little difficult to understand theoretically. We'll come to the explanation. Basically, they are giving you a leeway of 10% of the stamp duty value as a benefit of doubt and allowing you that concession. So let's take an example. A receives 10,000 rupees each from 3 of his friends, X, Y, and Z. So totally he gets 30,000 rupees. Although these X, Y, and Z are not relatives in the definition of relatives, because the total amount does not exceed 50,000, nothing will be taxed in the hands of A. Another example, A receives 5,000 from his friend X, 1,000 from his neighbor Y, and 70,000 from a local MLA, member of Legislative Assembly, as gifts. So totally he receives 76,000. All the 3 persons are not considered as relatives for the purpose of this discussion. And because 76,000 is in excess of 50,000, the entire amount of 76,000 will be taxable in the hands of A as income. Another example, A receives 25,000 from his friend X, 10,000 from his friend Y, and 70,000 from his father Z. So totally the person receives 1,05,000 rupees. 1,05,000 is more than 50,000. So now we have to look whether the gift is from a relative or a non-relative. Out of 1,05,000, 70,000 is from the father. Father falls in the definition of relative. Therefore, you exclude that. What remains is 35,000. 35,000 is received from non-relatives, but it is not more than 50,000. And therefore, again, nothing will be taxed in the hands of Mr. A. Now, let's take the example of immobile property and how the how the taxation of the gift would work. Let us say A receives immobile property from his friend X, and let's look at 2 scenarios, without consideration and for inadequate consideration. Let us say the actual consideration which is paid by A to his friend is 100 rupees and the stamp duty value is 90. So obviously the person has not got any benefit. He is actually paid more than the stamp duty value. So there is no question of inadequate consideration. Therefore, nothing will be taxed as gift, as taxable gift in the hands of A. On the other hand, if the consideration paid is 100, but the stamp duty value is 150, so the difference between stamp duty value and the consideration paid is 50 rupees. The entire amount of 50 rupees would be taxed as income in the hands of the recipient, Mr. A. If the same property where the consideration paid is 100, but the stamp duty value is 102. Now look at the difference between this example and the earlier one. Earlier stamp duty value was 150, now it is 102. The difference between stamp duty value and the actual consideration is 2 rupees, which is less than the 10% of the stamp duty value. So that being the case, because of the leeway given, because of the benefit of doubt given, whatever you would like to call it, it could also be called a safe harbor. Because of that 10% safe harbor, since the difference is only 2 rupees, nothing will be taxed in the hands of Mr. A. And the last example is where nothing is paid by A to the donor. The stamp duty value is 100. The entire 100 would be treated as gift in the hands of the recipient, Mr. A. I've given simple figures. Obviously, 100 is less than 50. And just to illustrate how this would work, we are talking about values in excess of 50,000. Now let's come to inheritance. Inheritance or inherited assets are assets which someone receives on account of the death of somebody else and because of what is written in the will of that person. So inherited assets could include bank accounts, shares, securities, mutual funds, etc. They could include immobile property, or they could include other movable property like furniture, fixtures, car, etc., etc. Generally, inheritance would be by the children or family members of the person who is deceased, and it would be as per the will of that person. As far as taxation is concerned, at the time of inheritance, there is no tax application for anyone. So obviously, the person who is no more, there is no question of tax implication in that person's hand because the person is no more. But even in the hands of the estate of that person, there is no tax implication. As far as the person who inherits the assets, again, there is no tax implication at that point of time. But later on, if and when you transfer that inherited asset or sell that inherited asset, there would be taxation impact, and that would depend on the nature of the income earned. If that capital asset which you have inherited or what you have got as by way of gift, and you subsequently sell it, it will give rise to a capital gains, and the taxpayer will have to pay the tax on the capital gain depending on whether it is short term or long term. So one will need to get into the nature of the income that one earns at the time of sale of the asset, or if you have, for example, received shares by way of inheritance or mutual funds by way of inheritance or by way of gifts, and you receive dividends from those shares or mutual fund, then obviously that dividend income from that mutual fund or from that share will be taxable in your hands at the time of earning or accruing of that income. If you have got a bank account or a bank fixed deposit by way of gift or inheritance, again, the interest on that would be taxable in your hands. But on the principal amount that you receive by way of gift or by way of inheritance, there is no tax implication. The question that comes up is that we saw earlier that when you sell an inherited or gifted asset, there will be capital gains. In order to calculate the capital gains, one needs two basic data points: the consideration, the sale consideration, and the cost. Now, if you have received something by way of gift or inheritance, naturally, for you, there is no cost because you have not paid anything, unless, of course, it is a case of inadequate consideration. But otherwise, there is no cost involved in your hands. Now, in that point of time, what happens is that the Income Tax Act of India says that in case of gifted or inherited assets, the purchase price, the cost of acquisition in the hands of the earlier owner will be deemed to be the purchase price or the cost of acquisition in the hands of the person who has received the gift or who has received the inheritance. So for the purpose of calculating capital gains, whatever was the cost of acquisition in the hands of the earlier person would become your cost of acquisition. Similarly, if the earlier owner had incurred certain cost of improvement of the asset, then that will also be treated as cost of improvement in your hands. Cost of improvement means capital expense incurred by the owner to improve the title to that capital asset or to improve the asset itself. How does one determine whether an asset is a short-term asset or a long-term asset in your hand? As far as listed securities are concerned, units of UTI are concerned, units of equity-oriented funds are concerned, and zero-coupon bonds are concerned, if the period of holding is not more than 12 months, it would be short-term. If the period of holding is more than 12 months, it would be long-term. In respect of other assets, like unlisted shares, unlisted securities other than shares, immobile property, real estate, commodities or equity ETF, or immobile property being land or building or both. In that case, the period of holding would be 20. The cutoff would be 24 months for the purpose of deciding whether it is short term or long term. So if you have held it for more than 24 months, it would be long term. If you have held it for not more than 24 months, it would be short term. And why is this relevant? Why is it relevant to decide whether an asset is a short term asset or a long term asset? The reason is this slide, that the rate of tax for both types of capital gains differ. If you're talking about equity shares or equity-based mutual funds listed on a stock, equities listed on a stock exchange or equity-oriented mutual funds, if it is short-term, the tax rate is 20%. If it is long-term, the tax rate is 12.5%. For all other properties, for short-term, it is slab rate. For long-term, it is 12.5%. What is important to understand is that last year, in July 24, after the last Lok Sabha elections, in the first budget presented by the third term of the current government, they made an amendment, substantial amendments to the capital gains taxation, whereby the concept of indexation of cost has been done away with. There is a caveat to this general statement that indexation has been done away with. I'll come to that later. But by and large, as far as all of you are concerned, you are non-residents. For non-residents, there is no indexation available any longer, irrespective of when you acquired the asset. So it may feel unfair that you got an asset which you had bought in, say, 1970s or 60s or 80s or whatever, and you are not allowed to index your cost. But unfortunately, that is here to stay. So if you have earned long-term capital gains on any asset, the tax rate would be 12.5% on the entire capital gains calculated without indexation of costs. So let us see some examples of how the capital gains will be classified in the case of inherited or gifted assets. Rahul's father gifted bequeathed him a flat in October 23. The father had purchased the flat in 2012 for 90 lakhs. Now Rahul proposes to sell this flat in September 2025 for a consideration of 150 lakhs, that is 1.5 crores. So effectively, the question is that for Rahul, what is the date of purchase? Whether when he sells in September 25, now he has got the property in October 23, he got a gift, or he inherited the property in October 23. The relevance of September 25 is that between October 23 and September 25, the period of holding will not be more than 24 months. So technically, for Rahul, as far as Rahul is concerned, he has held the asset for not more than 24 months. Now Rahul needs to calculate the capital gains in his hands in September 25 when he sells the property for 1.5. As I mentioned earlier, the cost of acquisition for Rahul would be the cost in the hands of the earlier owner. Earlier owner was father. For father, the cost was 90 lakhs. Also importantly, the date of acquisition for Rahul would be the date of acquisition for the previous owner. The previous owner, the father, bought the flat in 2012. So for Rahul also, the acquisition date would be 2012, whatever it was in 2012. Now 2012 to 2025, obviously it is more than 24 months. Therefore, for Rahul, the capital gains on the sale of the house property would be long-term capital gains, and the capital gains will be 1 crore 50 lakhs minus 90 lakhs, that is 60 lakhs. No indexation of 90 lakhs will be permitted to Rahul in this case. Another example, Y inherited a residential house property from his father in November 22. The father had purchased the property in May 12 for 50 lakhs. On the date of inheritance, that is November 22, the value of the property was 2 crores. The person who has inherited, that is Y, has sold the property on 15th June last month, 15th June 2025, for 3 crores. So what is the capital gains, or what is the taxable capital gains in the hands of Y? I'll repeat the facts. Inheritance happened on 20th November 22. On the date of inheritance, the value was 2 crores. Now it is sold for 3 crores. The earlier owner, that's the father, had bought the property in 2012 for 50 lakhs. As far as the current owner is concerned, the consideration is 3 crores. As far as the current owner is concerned, the cost in the hands of the earlier owner, which is 50 lakhs, would be deemed to be the cost in the hands of the current owner. So 3 crore minus 50 lakhs, the capital gains would be 2.5 crores. The market value of 2 crores as on the date of inheritance is irrelevant for the purpose of calculating capital gains. Because the property was held in aggregate for more than 24 months, it would be long term, and therefore 2.5 crores would be the long term capital gain in the hands of a concerned person. So we have seen how the taxation works, how what is the implication of taxation in the hands of a person receiving a gift or receiving an inheritance. What is the tax implication in the hands of the inheritor or the donee when that person sells that asset? You have sold the asset, now you've got the money lying in your NRE or NRO account. What do you do with it? You can continue to keep it here and invest it through integrated enterprises in whatever asset class that you feel appropriate for you, or you may want to take the money back home to wherever you are. If it is in an NRO account, then the maximum limit which you can repatriate from India to USA or to any other country for that matter where you are located is $1 million per financial year. If it is lying in NRE account, there is no maximum limit. You can remit the entire. If it is in NRO account and you are remitting up to 1 million, what you will require is a Form 15CA, which is a self-declaration by you to be given to your banker, and you will require a Form 15CB, which has to be verified and signed by your chartered accountant. As far as repatriation of money from NRE to outside India is concerned, there is no. It's freely repatriable, and there is no Form 15 CA/CD required from the banker. Coming to, we were told by integrated enterprise that their annuity is an interesting and important or popular source of income for many people. So we have included the taxation of that as well. In the normal course, if you have a life insurance policy and you get back money in respect of that policy, including the accumulated bonus, there is an exemption available under Section 10 of the Income Tax Act. But this exemption is not applicable to a policy, to whatever you get back in respect of a policy which is issued on or after 1st April 2012, if the annual premium that you pay exceeds 10% of the sum assured. So to give an example, if the sum assured is say 50 lakh rupees and your annual premium is say 6 lakhs, so it is more than 10% of 50 lakhs, 10% of 50 lakhs is 5 lakhs, your premium is 6 lakhs. In that case, whatever you get back in respect of that policy, for that amount, this exemption will not be applicable. But this exemption, which is available to money received in respect of a life insurance policy, is not applicable to annuities received. So if you receive an annuity, and annuities can be of two types. One is an annuity that you get in respect of a policy that you have taken while you are employed here in India with a particular company, and in respect of that employment, you have got an annuity coming in. That is different. That is, while there is no exemption for that, but there is a standard deduction available of 50,000 rupees in respect of that annuity. But otherwise, the other type of annuity is a normal annuity, which you may get in respect of any other, annuity policy. That policy, that annuity does not entitle you to any standard deduction. The entire amount that you get back on a periodic basis, whether monthly, quarterly, half yearly, or annually, that whole amount needs to be shown by you in your computation of income for that particular year in India. So annuities received under an insurance policy are generally taxable under the head income from other sources. And therefore, if you get an annuity from a policy that your parent had bought in the past, where you are a nominee, then that annuity which you receive, even if that money is directly remitted by the insurance company to your bank account outside India, the income is accruing or arising in India, and therefore it would be taxable in India, fully taxable in India under the head income from other sources. So with this, friends, I've come to the end of the slides that I wish to present before you. I now request my partner Mitsu, who has been handling queries from NRIs for several years, and therefore she is aware of the common problems which most NRIs face. So over to Mitsu for taking over from here. If and when I feel I can add value to whatever she is speaking, I will continue to do so. Thank you.
Thank you, sir. Okay, so now let's understand what are the common problems that are faced by an NRI for the inherited or the gifted assets. Okay, the first main issue that comes into place is for the value of the immovable property. As you know, most of the NRIs who would have inherited the property could be around 15-20 years old property. So as per the income tax law, okay, if the property is purchased before 1st April 2001, you need to get a valuation of the property done as per the valuation officer. There's a registered valuation officer, and you have to get the valuation of the property done for the first, or as on 1st April 2001, to determine the cost of the property for computing your capital gains. Okay, this is the first issue that comes up. The other problems that are being faced is that the NRIs are born and brought up outside India, so they don't have, the parents have the bank account in India, but the children are neither a joint account in the bank or the nominee in the bank. So it becomes very difficult to transfer the assets in the name of the children. Also, as per Indian laws, there are certain times where the physical presence of a person is required in India for signing various documents or submitting various documents, and it's not practically feasible for everybody to fly down from US or any other country to India just for submitting the documents or signatures, etc. The other aspect that comes into place is the executor of the asset, wherein what happens is, in the year in which a person has deceased, two tax returns are being required to be filed. One from 1st April till the date of the death of the deceased, and the second will be from the next day of the date of the death till the end of the financial year. So what happens in this case is that the income which is of the deceased from 1st April till the date of death is to be taken into consideration as the income of the individual. And the second part, that is the executor of the asset, comes into place from the next day of the date of the death till the end of the financial year. In this case, what happens is that you need to obtain another PAN for the executor of the asset of the deceased individual. Obtaining the PAN for the executor of the asset is a very cumbersome process. It requires a lot of documentation, okay, which needs to be submitted to the income tax authorities to obtain the PAN in India. The other issue that comes into place is finding the documents of title and establishing the cost and date of acquisition. This is a problem which is being seen mostly in the case of shares and mutual funds which are purchased various years ago, for which we would not either have the cost or the date of acquisition, because we find difficulty in finding the documents which are required to establish the cost of the asset. The next that we come on to is the next slide. Yeah, the documents to avoid these problems, okay, or to minimize the problems. I would not say avoid, to minimize these problems, we could take certain precautions from our end, and you could keep certain documents ready if it is possible. Okay, so for the gift, we could have, there are no standard documents, these are just based on our experience, what we feel that this could be kept for easy reference. One would be the letter from the donor mentioning, the date of gift, the details like what is given as a gift, what is the mode of the gift, the amount of the gift, and the fact that the gift is given out of a natural love and affection, and the PAN of the donor. Also, if the gift is given via a bank transfer, we could keep the bank statement handy for both the donor as well as the donee. This is very much relevant because you would have given a gift today to someone, and maybe 10 years down the line the person would come into question that when and how the gift I have received, from whom I have received. So, and going back 10 years down the line, if you go to the bank and tell them you give a statement, it is practically not possible for the bank to give you the statement. So it is better in hand to keep it ready at the time when the gift is executed. To this, we come to the next part, which is the common questions that are asked. So these are certain common questions that we have come across, and we just try to put in the presentation. Okay, first is, I'm an NRI living abroad and my parents are living in India. If I send some money to them as a gift from abroad by way of transfer from NRO to NRE account, is there any tax to be paid by anyone in India? The answer to this is no, for a very simple reason, which is explained in the earlier slides by Mr. Amit Patel, is that son and daughter are recognized as a relative as per Section 56 of the Income Tax Act. Therefore, the gift by you to your parent will not get covered by income tax. The important thing that needs to be understood over here is that it does not matter whether the gift is coming, from India, from your Indian bank account, or you're from overseas bank account. Both of them would be treated as an exempt in your hands. The second question, that is, I am living in India. My son or daughter is an NRI living abroad. If I send money to him or her as a gift, is there any tax to be paid by anyone in India? Also, what is the maximum amount I can send by way of gift? So the person receiving the gift is again your son or a daughter. Again, the same, they get covered under the definition of a relative under Section 56 of the Income Tax Act. Therefore, the money that you transfer or the gift that you give will not be taxed in the hands of the recipient. But the catch point over here is that as a resident under the LRS scheme, you can only remit USD 250,000 per year outside India. The other question that comes is that this is very commonly known, fact which people are doing it, is that I'm living in India and my son and daughter is an NRI living abroad. I want to send more than USD 250,000 as a gift to my son and daughter. Can I transfer the INR equivalent to USD 50,000 to my wife, and then can both of us transfer USD 250 each to our son or daughter under the LRS scheme? This is very much a gray area and prone to very different interpretations. In our view, it is advisable not to resort to any of such actions and restrict your remittance to the USD 250 per person per year only in respect of the income who has or his money it is transferred out of India. We would also like to know that the banks have become very strict in this, aspect, and they have been scrutinizing these kind of transactions and are asking various questions and asking for various documentation to make such transfers, because most of the banks, the husband and wife would have the same they would have the account in with the same bank, so it becomes very easier for the bankers also, to scrutinize such kind of transactions. One of the other questions: I'm living in India and my son and daughter is an NRI living abroad. Can I gift shares owned by me in India to my son and daughter? Is there a limit for this? So for transfer of shares, there is an RBI approval required, and you can only gift up to 5% of the paid up capital of the Indian company, and the value of the shares which are gifted does not exceed USD 50,000 during financial year. Also, the transfer can happen only to a relative which is defined under the Companies Act 2013. With this, we come to another aspect, which is double taxation avoidance agreement. Let us understand what is double taxation avoidance agreement. Double taxation avoidance agreement is an agreement between two or more countries designed to prevent individuals or business from being taxed twice on the same income. The main purpose of this DTAA is to ensure that the income earned by a resident in one country is not taxed twice. That is, once in the country of residence and the other in the country where the income is earned. Now, who is eligible for claiming the tax benefit under DTAA? Let us understand that. For claiming the relief under DTAA, one needs to determine whether there is a existing DTAA between those two countries. For example, India and US have a DTAA. So the audience at present who are from US can avail the benefit of DTAA subject to the following: that an NRI can claim that tax benefit under DTAA only if the income which is taxable in the country of residence and the source. So for example, you have earned an interest income in India on your NRO deposits, and you would be paying taxes on your interest income in India, as well as the same will be taxed in your USA. So whatever tax that you have paid in India, you can claim the benefit of those taxes in the US subject to US laws as per the India-US DTAA. The other example is your interest on your NRE deposits. The interest income earned from your NRE deposits are exempt in India, so no taxes are paid in India. Okay, so for in that respect, DTAA benefits would not come into picture. To claim the DTAA benefit, one of the important document which is required by an individual is the tax residency certificate by the tax authorities of the country in which he resides. In India, if you become a resident and an ordinary resident, then in India, you want to claim the DTAA benefits, you need to file the Form 10F for claiming the DTAA benefits. With this, we come to another aspect of filing of tax returns. We've decided to put this because the due date for filing the tax returns for financial year 24-25 is fast approaching. As per the law, the due date for filing the tax returns is 31st July. But for the financial year 24-25, the software or the utility has undergone a change, and hence it is extended to the 15th of September 2025. So all those who have income in India and have not filed the tax returns till date can please file the tax returns. So let us understand when it is mandatory to file the tax returns for an NRI. As per Income Tax Act, NRIs are mandated to file an income tax return in India only if the total annual income in India exceeds INR 2,50,000 as per old regime or 3 lakhs as per the new regime. The 3 lakh limit has been increased to 4 lakhs from financial year 25-26. That is the financial year which is currently going on. Apart from this, there are other conditions also laid down by the Income Tax Department for which mandatory require filing of tax returns by an NRI. The conditions are: if you have deposited or aggregated total amount of more than 1 crore in any current account, deposits amounting to more than 50 lakhs in one or more saving bank account, if you have incurred a foreign travel for yourself or any other person exceeding 2 lakh rupees, if you have incurred an expenditure and consumption of electricity of more than 1 lakh rupees, if you are doing any business in India, then your gross receipts exceed 60 lakh rupees. If you are in a profession in India, if your profession receipts exceeds 10 lakh rupees, and if your aggregate of TDS or TCS deducted or collected exceeds 25,000 rupees. For this, I would like to give an example that suppose you have earned your interest on your deposits in India from your NRO account of rupees 1 lakh rupees. 1 lakh rupees is your interest account on interest on NRO deposits. On this, the bank would have deducted TDS at the rate of 30%, which comes to 30,000 rupees. Now, INR 1 lakh is below the threshold limit of 2,50,000 or 3 lakh rupees, but the TDS amount is more than 25,000 rupees, which is 30,000 rupees. In such a scenario, also, you are mandatorily required to file the tax returns, even though your income is below the basic exemption limit. Once we have determined that whether we are required to file the tax returns, it is important for us to know which form is applicable to a certain individual. So for the NRIs, we have two forms, ITR2 and ITR3. For individuals, we have another forms for residents, which is ITR1 and ITR4, which are not applicable for NRIs. ITR2 is applicable for all the NRIs who have all the other sources of income except for any business or profession in India. So you have to file ITR2. So if you have, interest income, dividend income, capital gains, rental income, then a salary income in India, all that gets covered under ITR2. You need to file ITR2. If you are doing or carrying on any business in India, then apart from the above income, also you need to file ITR3 in India. This is another one of the aspects, which was being informed to us that we need to cover in our presentation is for the residents. This is in the ITR forms, that is a schedule called FA schedule, which is a foreign assets schedule, which is required to be filled in by a person who is a resident and ordinary resident in India. And certain details of your foreign assets needs to be reported in India. So the time, suppose an NRI returns to India, this is relevant for an NRI who's returning to India. When an NRI is returning to India and he becomes a resident and ordinary resident in whichever financial year, he or she will have to report his foreign assets in the income tax return form. So let us understand what all needs to be reported. So first thing, the foreign assets held any time during the year needs to be reported, and it is over here the reporting is on calendar year basis. Income tax in general speaks about the financial year, which is April to March. This is the only schedule in the income tax forms which require you to provide the details on the calendar year basis. This is mainly brought in by the government because most of the foreign countries follow the calendar year basis. What all we need to report is the foreign deposit accounts or the custodian accounts, foreign equity and debt interest earned, any surrender value of the foreign insurance or the annuity contract, any financial interest in any entity outside India. If you're a director in any company outside India, you need to report that. You have any immovable property outside India, you need to report that. Any capital assets outside India, or any other account in which you have a signing authority. Now, this is very much important because what happens is, suppose there are husband and wife, and husband has a foreign account in India in which the wife is only a signing authority. She has not earned any income. She is just the joint holder in that account. In such a scenario also, if husband and wife both are resident and ordinary resident in India, in both the income tax returns of the husband and the wife, we will have to report this account details mentioning that you are a signing authority you have a signing authority in an account outside India. You need to report if you have created any trust outside India or any other income which is derived from any source, from any foreign source. To this, we come to another important aspect, which is the TDS, which is tax deducted at source. For any payment that a resident makes to an NRI, tax is withheld at source, this is called the TDS. The TDS is generally at 30% plus cess. But in case of, if you're selling a immovable property, the buyer has to deduct TDS on the gross sale consideration at the rate of 12.5% plus surcharge plus cess. To this, I want to give an example. Suppose you have sold a property for INR 10 CR. The buyer will deduct the TDS on 10 CR at the rate of 12.5% plus surcharge plus cess. However, when the individual is computing the capital gains on the property on which the tax is required to be paid, the tax will be paid by him only on the capital gains. So there is always this drift between the buyer and the seller saying that you please deduct, my capital gains is only say 5 CR or 6 CR. You deduct TDS on the 6 CR. But the law is very clear. If the payment is made to a non-resident, the property is purchased from a non-resident, TDS will be deducted on the gross sale consideration and not on the net capital gains amount. Also, if the NRI want to, go and, opt for a lower deduction of tax certificate for withholding of tax, they need to apply to the income tax authorities in India and obtain a certificate from the income tax department. This is, however, very cumbersome process and requires a multiple follow-ups with the income tax department to get the certificate. And if you are in a want to close your transactions soon, this would not be an advisable option for an individual. With this, we come to the end of our presentation. Thank you everyone for being a part of this presentation. If you have any questions, we are happy to take it up.
Thank you, Mr. Amit and Ms. Mitsu, for that insightful and enlightening session. You have comprehensively addressed the key aspects of gift and inheritance planning, making it simpler for our NRI participants to navigate these important matters. Thank you so much. Now, to wrap up the question and answer segment, I invite my colleague, Mr. Anand, to share the questions received in the chat box. Over to you, sir.
Thank you, Madam Basmati. Thank you, Mr. Amit Patel, sir, and Ms. Mitsu Dalal, and behind the screen, Mr. Sachin. And in fact, whatever the reply we have, what are the questions which has appeared in the chat box has already been replied by Mr. Sachin and Ms. Mitsu Dalal. But on going through this presentation, I have got certain few doubts or that we clarified. One is that Mr. Amit sir, you have mentioned that the over and above the 50,000 rupees the gift which has been received, the amount with the over and above 50,000 is taxable, or the entire component is taxable, sir?
The entire amount. So if the gift exceeds 50,000, the entire amount is taxable. 50,000 is not a threshold, but it is just the eligibility figure. Up to 50,000, no tax. Above 50,000, tax on the entire amount.
Understood, sir. Okay. Another point is that with respect to this definition of relative, nowadays now it is being happening in such a way that all the assessments are happening in faceless assessment. So in such a case, what is the proof that NRI need to maintain to prove that that particular donor is a relative? For example, if it is father, son, daughter, all these things, we have got certain other documents where we can prove the relationship. If it is if it is brother, sister, or father's brother, sister, how do we maintain the proof for those things which we can prove to the assessment officers?
So interesting question. Nobody has asked this before, and gets me thinking. First reaction, Anandji, to your question is that it really doesn't matter whether it is faceless or physical. Ultimately, if the officer is a crooked fellow, no matter what you do, even if you bring your parents and your siblings to the office, the officer is not going to believe you. So the question is that how does one prove the relation between you and the other person? Interesting question. I think and now let's stick to the faceless regime. In the faceless regime, we have our experience shows that it is absolutely critical as to how you draft your responses to the tax officer. What you write, because what ultimately the officer is going to base his decision on what he reads, what have you submitted to that officer by way of your written submissions. So one has to be extremely careful while drafting the submissions to the assessing officer during a scrutiny hearing or even in appellate proceeding. In the submissions that you make, I think the whole family tree could probably be brought out. The patriarch, mother, the sibling, the next second generation, etc. Bring out all that. That is one part. The other part is a confirm, which Mitsu mentioned, what kind of documentation one should ideally maintain. A confirmation from that person who has given the gift is critical. Unless you have that, you will not be able to prove that you got a gift from that person. So a confirmation from the brother, sister, family, whoever has given the gift, bringing out the relation also. So I will say, for example, if I'm giving a gift to my daughter, in the confirmation I'll write that I hereby confirm that I have gifted rupees 1 lakh rupees to my daughter so and so out of natural love and affection on so and so date by way of transfer from my bank account with say Kotak Mahindra Bank to her bank account number so and so with say HDFC Bank or whatever it is. The more facts you give, which are easily which can be easily verified, the more stronger your case becomes.
Understood, sir. Thank you. Thank you very much for your detailed clarity on this thing, sir. Mitsu, ma'am, with respect to this, one of the illustration you have mentioned that $250,000 which has been routed through the spouse. Yeah, that is a gray area you have mentioned in the illustration. Can you please just explain me or just briefly tell us exactly what is the possible risks that are involved in doing this particular activity? I mean, particular process.
I'll handle that in place of Mitsu. See, basically, this is a FEMA requirement. I had mentioned earlier that we will not get into the details of FEMA, but this is an important point. So the LRS, etc., are all as per RBI's regulations. RBI comes into the picture when you're talking about Foreign Exchange Management Act.
Yes.
So if there is a violation of FEMA, whatever violation, if there is a violation of FEMA, it has serious repercussions, and the authorities can hound you till and make your life miserable if they feel that there is a FEMA violation. So if in the same example, somebody wants to remit say 10 crores to one's child living in USA, and 10 crore is obviously more than $250,000 worth of INR. So it will require 2 installments. The 2 installments could be by way of spreading over 2 years by the same person, or 2 people sending in the same year different amounts aggregating to 10 crore worth of foreign exchange. Now, if my wife doesn't have money, all the money is in my name, and we still want to transfer 10 crore rupees, what some people have been doing is the husband gives a gift to the wife of X amount. The 10 crores is broken up into 2 parts. I will remit up to $250,000 under my LRS limit, and the balance amount out of 10 crores. So it will be say another 1.5 to 1.4 crores, based on depending on the exchange rates. That amount will be transferred by my wife, but my wife ultimately has got no money. Now, when you are remitting the money, there are certain declarations that one has to give to the bank. In effect, the declaration says that I am sending my own money. Now, if you have got a gift, it is certainly not your own money. If somebody else has given you the gift. So our view is reasonably clear. We do not advise our clients to get into this kind of arrangement to get out of the LRS limit problem. And if at all you're caught, there could be FEMA. The RBI could say that you have violated FEMA, and they could go after you and based on the violation. Under FEMA, unfortunately, the kind of money that they can levy on you, the penalty that they can levy on you is could be more than the amount involved, the amount of violation involved. So it's extremely expensive. If you get caught, you're in for deep trouble.
Okay.
Mr. Anand and
Understood.
Mr. Amit. So due to lack of time, the rest of the questions would be answered through email and would be published on our website. So on behalf of Integrated and the entire NRI Wealth Plus team, we sincerely thank Mr. Amit Patel and Ms. Mr. Dalal for taking the time to guide us with such a clarity and depth. We also extend our gratitude to our attendees. Thank you for your active participation and engaging questions. We hope today's session would have been informative and given you actionable insights for safeguarding and planning your inheritance wisely. We look forward to see you in our upcoming webinars. Thank you and have a great weekend.
Thank you.
Thank you.
Thank
Good
you
day.
all.
Thank you.